Hey everyone, welcome back to the channel. Today I want to talk to you about stock trading. I'm going to share my story of trading stocks over the last 3 or 4 years, what I've learned through going down this journey and process, things that you should watch out for, and hopefully provide you some tips and some foundations for how you should go about learning to stock trade on your own. So before we get started, I want to be transparent with you and tell you that I'm not a professional stock trader by any means. But I have gone down this journey myself, and over the last 3 or 4 years, I've used stock trading in my active investing strategies to build and grow my own wealth. And I have traded across a number of different assets. I've traded conventional stocks and equities from the US stock market, NASDAQ, NYSE, AMEX, and I've also traded different cryptocurrencies, Bitcoin, Litecoin, Ethereum, and even some altcoins or coins, as you've probably heard before. Now, me giving you those statistics is not to say that I'm the best investor in the world, because a lot of your ability to earn money really depends on how much you're trading and what opportunities are available for you for trading. In terms of the stock market, even with my funds, which have been growing consistently over the last couple of years, I'm still a really small fish in a huge pond or ocean. People like Warren Buffett have to manage billions or hundreds of billions of dollars. I have a huge advantage over professional fund managers like that. I just have to manage my relatively small amount of money and pick a few winning stocks and make a few great trades over the course of an entire year. I don't have to systematically deploy large amounts of capital and deal with the regulation and overhead of managing that kind of money. And in most cases, the assets that I'm investing in are fairly liquid, except for crypto, where I'm not moving the market very much. So it makes it very easy for me to get in and out without disturbing the market much and causing a lot of slippage and losing a lot of profit that I have gained. So my goal for this video is to provide for you a foundation for which you can build your own stock trading strategy and solution off of. I want to share my experiences, what I've learned, the biggest takeaways, and the biggest guiding principles, which I think will make you successful in this endeavor. I also want to give you a couple things to watch out for and things to avoid, which could really save you a lot of time and money, hopefully. So before you get into this space, you have to be wary, because there's a huge industry around trying to sell you shovels, essentially, trying to capitalize on your willingness to try and learn how to stock invest, make mistakes, and there's a lot of people trying to take advantage of that. They're trying to give you fake information or sell you services or products that aren't actually qualified. People charge hundreds or thousands of dollars for trading resources or signals, and a lot of times they're promising you something that's not realistic. And for someone like you who's struggling to find good information or really wanting to achieve your goals quickly and immediately, you've become easy prey for these people that are trying to take advantage of you. So you really have to be careful about who you're listening to, who you're giving your money to, and these track records of these people that are so-called experts and gurus. The first thing you should do when you find someone on the internet who's giving advice is you want to decipher if they're telling the truth or not. You want to find out their pedigree, their track record, and see if they're legitimate. So I think there are a couple of easy tells for distinguishing really successful people and people that are just trying to sell you some BS course that doesn't have any real value. And that is to look at if they're really great marketers or if they themselves have achieved a great level of success in this space that they're trying to teach you about. I think you'll find that a lot of the industry experts aren't really good at marketing themselves. They're not really interested in going out and creating a course and trying to make side income or replace their income with this type of side income. Some of them, after a couple of years, are looking to give back, and most of them are not going to be as honed marketing machines. So if you ever run into a guru who's really a silver-tongued salesman, you really have to ask yourself, are you being sold a shovel? Is this person actually qualified to teach you? And are they who they say they really are? Do they have a track record, and are they well known in the industry by actual industry professionals, not just other gurus in the space? Now, if you delved into the space at all, you probably heard names like Tim Sykes or Peter Brandt. Now, I don't want to say too much about these people specifically, but I will share my experience of having taken their courses or looking through some of their material. Now for me, Tim Sykes, he falls more on the heavily marketing side. He's had his own TV show, he definitely has some followers and disciples. He's made his career seemingly by promoting his own brand, by selling these courses on how to trade stocks. And when I went through his course material, to be honest with you, I didn't find it that useful. It provides some information about how to actually trade stocks, but in general, I found it too high level and not actually something implementable for the average person. Peter Brandt, on the other hand, has spent decades in the industry. He started out as a trader himself, and he's published his own tax filings and records of how much money he's made over the last couple of years. So to me, he seems much more reputable. Now recently, he has gotten more into the selling courses and signals space, but I don't think that that's his primary business, even to this day. So even for me, it's hard to decipher if these people are real or not. but from the information that I've gathered, I would say that Peter Brandt is someone in this space that's good to follow. And at the end of this section, I'm going to give a couple more names for people that you can follow. But this is definitely one thing that you want to watch out for, and you want to do your research before you start paying any money or taking the advice of any of these gurus. Now, the second thing that you should watch out for in this space are people that are trying to talk their own books. Typically, these are people that are professional traders or fund managers. And in this specific case, they've already taken a position in a particular asset. And then they're going on CNBC or they're going on crypto Twitter and they're talking about how this is a great opportunity, and they're trying to get you to buy in and basically be the dumb money and provide liquidity for them to either help grow their position and add momentum, or to give them liquidity to get out of the market. An extreme example of this is something like a pump and dump scam, where people have already taken a big position in something that's fairly illiquid, and they've gone on to Twitter to try to get you to promote the price. And because the liquidity is thin, any kind of outside interest quickly drives the price up. At which point they sell and basically dump on you, the dumb money who listened to their advice, who is trying to make a quick buck and not do the homework themselves, and you get taken advantage of. So you definitely want to be careful of these people as well. And the third thing that you want to be careful of are these so-called experts, economists, or talking heads that are on TV. A lot of them make the majority of their income through these talking arrangements, and they don't actually make a ton of money through their own investment. Also, when they're coming on TV and they're talking about these things, you have to question what their motives are. Is there an agenda behind what they're doing? Are they talking their books, or are they just simply uninformed and don't actually have their ear to the market and know exactly what's going on? Are they going on TV and trying to entertain you, or are they really trying to give you sound advice? And if it's being broadcast on national TV, how valuable is that information that they're giving to you? Because everyone else in the world has it as well. When you're in that kind of position and you're listening to an expert that's on TV, you're kind of, by definition, one of the crowd, one of the herd. And the majority of the money is made before or after the herd comes in or leaves. You don't want to be the one that's part of the herd. And the last thing that you have to be careful of is that everyone has an opinion about the stock market. People that don't invest professionally, that haven't made money in decades, or aren't professional traders, or don't really know what they're talking about, have an opinion. This could be your taxi driver, it could be your parents, could be your friends and family, it could be just random people on Twitter or on TradingView. People like to talk about their positions and what they've done and how they made money and try to act smart in front of you. But you have to be sure and careful about what you're listening to and really take into account how credible these people are. At the end of the day, it's your money and your responsibility to manage. You have to protect yourself and insulate yourself from people that have bad ideas or aren't really qualified on speaking on this subject. Now, I want to give you guys a couple names for people in this space that I think you can trust. Over the last couple years, I've taken a number of courses and done a lot of research online. I've listened to a lot of different so-called experts, and I've tried to follow what they say and see if what they say has any merit. And of all those experts that I have kind of vetted, only a couple of them I think stand up under scrutiny. And the first one being Peter Brandt. I've read a couple of his books, and he definitely has a very storied history of trading over the last couple decades. Recently, as I said before, he's come on Twitter and he's now offering a course and some information to people that are just starting out. But I do think that his knowledge and experience is definitely valid, mainly because he's pretty transparent about how much money he actually makes. His fund, Factor Trading Company, actually has to publish how much money he makes every year. And I think on an annualized basis, he's made something like over 30% year over year for the last couple decades. So the guy definitely knows his stuff. And when you start listening to him, you're really gonna see how at his core, he's really a nerd. He's someone that lives and breathes by stock charts and trading. He's not a professional marketer, and that's not how he's making the majority of his income. So here's one of Peter's books which I've read through, Diary of a Professional Commodity Trader. I read this book over the course of 1 to 3 days, and I have to say that it is full of a lot of useful information. Not only does he go over the high-level fundamental information that you need as a trader, but he also gives specific examples and strategies and does a play-by-play about what kind of trades he makes and his thought process. And I found the latter to be super, super important and valuable. So if you're just starting out, this is an excellent resource which I would recommend to you, at least for you to get a taste of what it's like to be a trader. Another book that Peter Brandt has is called Trading Commodity Futures with Classical Chart Patterns. I haven't read through this one yet, but I think it's gonna be pretty good. If you're not familiar with Peter Brandt, a lot of his trading strategies are based around chart patterns. He combines chart patterns with also ways for managing his capital and risk, and that's yielded the great success that he's had over the last couple decades. And he's not alone. There's a lot of professional traders that rely on these chart patterns, along with some other things, to make informed decisions about how they want to trade the markets. So Peter is definitely legit in my book. I've linked to Peter's website and 2 books below. I definitely recommend you start with those 2 books and see what you think of his material, and if you like it, then maybe consider taking his program. So to be totally transparent, I'm not making any money from Peter, And really, I'm just starting to grow my YouTube channel, so I can't really make money on these affiliate links either. And I'm really only making this video because I want to share my own journey and hopefully help you out. If you do appreciate this video though, it would help me a lot if you could like this video and follow my channel, because that's really going to signal to the YouTube algorithm that the content that I'm producing is valuable to some amount of people, and hopefully that helps me grow my channel and allows me to continue making these types of videos. And another personality online that you should look into is someone called Miss Snyder, or Michelle Snyder. She's from marketgauge.com, and she, like Peter Brandt, was also brought up trading stocks herself. And then later on, she added a service and some training courses for people. But to me, she still seems like she makes the majority of her income from trading. She seems very well informed, and she definitely has a lot of experience, and she definitely demonstrates a lot of deep technical knowledge in her analysis. And I've also read her book, Plant and Grow Your Money Tree. Compared to Peter Brandt's book, I think it's a little bit more practical, and she tells a couple more stories about day-to-day activities and ways on how to spot a great stock or investment opportunity. I would say that Peter's seems to be a little bit more technical, but hers is still full of great information on how to stock trends in stocks early, and also how to do a technical analysis of stocks as well. Both Peter and Michelle base their trading on technical analysis, and that's also what I base my own strategies on as well. However, their styles and the indicators that they look at are a little bit different, so I'd recommend you take a look at both of them and decide which one is the best fit for you. Now, partly why there's so much information out there about stock trading is because there's not one strategy that always wins. There's a lot of people that trade using a multitude of different strategies, different time frames, and different philosophies. And you really have to develop the one that's perfect for you and suits your own personal traits and abilities. That said, there is some information that I can lend you, which I think will be super helpful and is broadly applicable across the majority of strategies. These are things that people I know that trade professionally monitor and take into account when they're making trading decisions. And they're also things that have worked for me in the past as well. Now, the first thing you really have to internalize when starting down the journey of learning how to stock trade yourself is that there is no magic bullet. There is no one size fits all on how to stock trade the best. And there's no guarantee, even if you pay a lot of money for these trading seminars or services, that the strategies that are taught in those services are going to be applicable to you. That's because a large part of the trading process involves your own decision making, how you handle stress and emotions as well. In general though, if you want to learn how to stock trade, you need to have a couple things. The first thing is that you have to have patience. You have to understand that this is not going to be something that you're going to be able to do in 1 week and start making hundreds of millions of dollars. It's something that you're going to have to build and improve over time. And this is something that Ray Dalio, one of the legendary hedge fund managers, talks about in his book Principles as well. He talks about this loop of learning. Basically, you set a goal, you strive for it. As you fail, you have to pick yourself up, learn from it, and then keep growing. And through this constant cycle of failing, learning, and succeeding, you can grow yourself into someone that is a professional stock trader or allow you to reach any kind of goal that you want to reach. But you have to understand that you will lose, and you will lose money in the short term. And the fastest way to succeed is to be as objective as possible. You should track all your trades, you should look at your own performance and decide if this is really for you, and then you should hang in there and learn and learn and learn and try and try and try until you succeed or you give up. I can tell you, after having traded for the last couple of years, you're gonna be your biggest worst enemy. Something about money in the stock market really can be gut-wrenching sometimes, especially when you're down a little bit of money or losing on a trade. It can really wreak a lot of mental havoc on you. So you really have to be careful and mindful of that. And you're not really gonna know how well you respond to these conditions until you find yourself in them. So I would say start small, be patient, and be prepared to lose a little bit of money and stay in it for the long haul. Okay, so let's talk about building your own strategy. I think the first thing that you have to decide is, what type of trader are you? Are you going to be someone that wants to look at the fundamentals, that is doing financial analysis on companies, or are you someone that wants to look at the technicals, basically stock charts and patterns, and only look at price to determine how to trade and manage your funds? I myself have found that technical analysis works for me, and I only look at technical analysis and price. I don't look at fundamentals at all, or if I do, I only look at it as an investment strategy, not as a trading strategy. For me, technical analysis, chart patterns, and the actions of price are the most important thing for my trading strategy. Now, the next thing you should consider is time frame. Are you going to invest and take positions for only a couple days, a couple hours, a couple minutes, or a couple weeks or a couple years? If you're looking at months and years, you're a little bit more of a long-term investor. And if you're looking at weeks or days or less than that, you're really more suited for trading. There's not really a right or wrong answer for any of these decisions. You really have to look at your own personal ability, what your own preferences are, and what actually works for you. Now, speaking about time frame, one of the most important things to understand is something called market cycle. Market cycle is something that all professional traders and majority of people that I know that do this professionally pay attention to. It's basically market sentiment and which part of the cycle you are in the market. You see, the market oscillates between being overpriced and underpriced, and these oscillations happen concurrently across multiple time frames. A good analogy to this is if you come from a science background and you think about the idea of waves. There are multiple waves with different periodicities, and they overlap and interfere with each other. And that interference creates noise and fluctuations within price. So it's important to align your time frame and investing time frame with the primary cycle that also matches what you're trying to invest for. That means if you're expecting the price to go up over the next 10 years, you're looking at a very long time frame. If the price drops over the next 1 or 2 days by a little bit, it really shouldn't concern you very much, nor should it change your investment thesis or how you're trading that position. I'm going to put Ray Dalio's debt cycle on the screen here. You can see that there's a line going from the bottom left to the top right, and along it there is another curve that starts out above it and then below it. That curve represents the market being over or underpriced, and the straight line represents a true fair value of the market. So you can see that it starts off as overvalued and then oscillates and goes to an undervalued state. But along this curve of being overvalued and undervalued, there's also a squiggly line that follows that curve. Those are basically short time frame oscillations, also between being overvalued and undervalued. So you can see that the price of any kind of stock or equity today is the combination of both these long-term cycles and short-term cycles. And as an investor or stock trader, you obviously want to buy when the price is undervalued and sell when it becomes overvalued. The time at which you buy and the time at which you sell is going to depend on your time frame and where you are in the corresponding market cycle. Now I'm going to put this other chart on the screen called the Wall Street cheat sheet, and it shows the market cycle of a single stock or equity. As you can see, the price starts out at a low point at disbelief and then goes towards hope, belief, and then at the end, euphoria, before it turns into complacency and then has a huge crash down, has capitulation, and then the cycle starts over again. This is something you can see in most stocks and equities that have been around years. Or if you're looking at cryptocurrency, you can see this play out since 2008 a couple of times, the most recent one being in 2017. Now it's important to understand this market cycle, but it becomes tricky to figure out where you are in this market cycle when you're making a trade. You can and should try and find correlators between price graphs and charts with this market cycle. But one of the biggest indicators that you're going to have is actually just market sentiment. That means, how do the people around you feel about a particular stock or equity, or about the stock market or cryptocurrency? How are talking heads on TV talking about your particular market? How are people on Twitter thinking about your market? You see, every point in the market cycle corresponds with a distinct emotional feeling. Disbelief, depression, euphoria all feel dramatically different. And you want to buy counter to market sentiment. Just like Warren Buffett says, you want to buy when there's blood running in the streets. When everyone is sure that the stock is going to keep crashing, that's when you don't want to buy. That's probably the bottom of the market. And when everyone is sure that the market can't do anything except go up, that's where you want to sell. And the reason for this is because prices are very much driven by supply and demand. When everyone thinks that the stock market is going to keep crashing, that's when supply is going to be exhausted. That means all the sellers that want to sell have already sold. All the sellers that didn't even want to sell because they're so scared have sold. And because no one else is selling, the price stabilizes and then can start its rebound. Opposite to this is when price has gone so high because everyone that wants to buy has bought. They're so sure it's going to keep going. They poured all the money that they can. They've taken out loans. They borrowed money. They're sure it's going to go up. Everyone's a genius. And at that point, there's no one else left to buy. The stock price can't do anything except stabilize and then turn around and start crashing. So one of the biggest clues that you have to where you are in the market cycle, besides just price, is market sentiment. Listening to your friends and family, seeing what the talking heads are saying, and trying to judge where you are in the market based on that. And that's really going to help you pinpoint where you are in the market cycle and make a good informed decision on how to trade and manage your money. Now, one thing I'll say about this is that every asset has its own periodicity. That means that this market cycle plays out over a different time frame for each asset class. For example, the US stock market basically has market cycles that last about 10 years. For cryptocurrency, that market cycle could just be 2 or 3 years. When you're talking about a market that has cycles over decades, it can be hard to have experienced every part of the market cycle. That means that you as a trader may not have lived through a giant crash or a huge run-up, meaning that you don't have the experience to necessarily be able to recognize the signs. So that is, I think, one advantage of cryptocurrency. Because the market cycle there is still very early and still very short, you can, and I have, experienced all the highs and all the lows of a market that can only go higher or a market that can only go lower. And that has kind of tuned my understanding and acuteness to the people around me and their emotional state, and allowed me to learn how to kind of pinpoint the market cycle based on those people around me and their emotions. And I think that's actually a hugely powerful lesson that I gained by trading cryptocurrency. Now, we talked about what to watch out for, the big market cycles, which apply to almost everyone in every kind of trading strategy. Now I want to talk a little bit about my own strategy. My own strategy I've developed over the last 3 or 4 years, and it's not something that I can share with you just in this video alone. So it's something that I will talk more about in future videos if you're interested. But for this video, I do want to give you a high-level overview of what I do and what I pay attention to and what makes up the core components of my trading strategy. Now, the information I'm going to provide in the next couple of minutes is information I've gathered from my own trading, and it's just my own personal experience. I hope that it helps you, but please take it with a grain of salt and weigh it against what you hear from other experts out there. Now, the core of my strategy is technical analysis. That means I look at price and price charts alone to try and determine when I should buy and sell a stock. I don't look at fundamentals at all. I don't try and pay attention to the news at all. I try and just look at price and price behavior itself. And the reason why I do that is because it's very hard for me to understand how to value news and information out there. And that might be pretty surprising or counterintuitive to you, but it's something that you would only come to after having played around in different markets and having tried to correlate news with price action before. What I found is that it's very hard to correlate news with resultant price action. If there's quote unquote good news, does that mean price should go up or go down? You're probably saying to yourself, Xander, that's pretty dumb. If there's good news, the price should go up, obviously. And if there's bad news, the price should go down, obviously. But it's not as simple as that, because news still has to correlate with the market cycle. You could be in a part of the market cycle where good news doesn't help at all, or where bad news doesn't matter at all either. During Bitcoin's run-up in 2016 and 2017, there are a lot of really bad news that came out. China banned Bitcoin, certain exchanges got hacked, but in all those cases, price fell only temporarily or not at all, and continued on its massive bull run up to 20,000 at the end of the year. In trading, there's something called buy the rumor, sell the news. That means that a stock might be underpriced, and when there's a rumor of something good happening, people are buying in anticipation of the news announcement happening. And that means by the time that a news announcement actually happens, even if it's good news, that news has already been priced in, and because it's overvalued at that point, after the news event actually comes out, the price might crash. So as you can see, and from my own experience, it's really hard to correlate news with price action. And so I just don't do it. I assume that news is baked into price. That is, I assume that news is baked into the price now, that every equity, stock, or crypto out there is perfectly priced at its current instant in time. That is, the current price is always the correct price because that is the price that people are willing to trade at currently. That means that regardless of any news out there, regardless of any insider information, regardless of any inefficiencies or efficiencies in the market, the current price takes that into account. And for me, that simplifies my framework and strategy for how to buy and sell stocks. And so for me, I only look at price because I assume that it takes into account all these other variables, which I myself would not be able to manage or take into account otherwise. Now, there is an exception to this, and I would say that this exception of fundamental analysis really applies more to investing, not to stock trading, and that is to identify a product or trend that's very early in its cycle. For me, I've been working in the technology domain for the last 10 or 12 years, so I understand technology very well. And when Tesla was coming out and that technology was being made, and after having been in a couple of those cars and speaking to investors, I was very sure that Tesla was going to be worth a lot more in the future. And so that gave me the confidence to buy Tesla stock and hold it, knowing that fundamentally it was going to go up in value and play a bigger role in our lives in the future. But that's different. That's really not stock trading. Here, I'm talking just about stock trading, and I would argue that that kind of information about if Tesla is a good product or not doesn't really come into play too much in terms of trading, especially if you're talking about short time frames. And that's because even though Tesla makes a great product, it could be that right now in its current market cycle and over the time frame that you're trading in, it's overvalued and the price has nowhere to go except down. Now, when it comes to trading, there's also different types of trading. There's day trading, there's something called swing trading, there's something called high frequency trading, and then there's arbitrage. I'm gonna go over these different strategies briefly. So the first is day trading. This is taking positions that are a few hours, a few minutes, basically over the course of a day. You're gonna be in and out, make your move, try and make a little bit of money, maybe follow momentum, and then be out of the markets. You're not really holding onto trades for more than a day or overnight at all. The next type of trading is called swing trading. This is a strategy that plays over a few days, a few weeks, or even a couple months. And it's basically trying to pick the big market bottoms or market tops in a particular cycle and try and position yourself to take advantage of the meat of that move afterwards. So, after this recent crash in March, you are buying and you're holding and you're waiting for a couple of weeks and the prices rebound and then trying to sell there. So you're trying to pick the large tops and bottoms and you're not trying to micromanage along the way. And for me, I found that this is the most profitable strategy. Now, the next strategy is high frequency trading. This is quite technical in nature. Normally, it involves having large computer systems and programmers that write strategies that also take advantage of latency and the network to have an advantage over other traders. The last one is called arbitrage, or using trading bots. This is also typically done programmatically, and it involves taking advantage of the price difference between different exchanges or different currency pairs or cryptocurrency pairs, and basically making very risk-bounded trades where for sure you're going to make money, and you're making most of your money through high volume trades or doing this hundreds or thousands of times. This is not something that you typically do manually, it's something that you do with the help of computer systems. So as I said, I like to do swing trading. I'm picking tops or bottoms over a couple days or a couple weeks, depending on what type of opportunities I see in the market. In this type of trading, I basically want to get in towards the bottom in anticipation of a rebound or change in direction of price, and then I want to try and ride that change in price as long as I can and keep my profit. Now, the way that I approach trading is probability based. That means that I have a couple of different indicators, maybe 2 or 3 big ones that I pay attention to, and then I also take into account market cycle and market psychology and emotion. And from that, I kind of build a probabilistic model on where we are in the market cycle and what's going to happen next. And that's all based on price information only. But that means that as more price information comes in, that means as I'm holding on to a trade and days elapse and price moves, I always reevaluate those probabilities and see if basically I'm on course and my original theory is on track to reaching my price targets, or if the price is diverging and doing something that I didn't expect. When price is doing something that you don't expect, you have to just get out of that trade, take your loss, right? Admit defeat, and try again later. You don't want to hold on to a trade that's moving in a way that you can't anticipate and didn't account for. So let's say I want to long a stock. I basically want to buy a stock because I think the price is going to go up. I'm waiting for my oscillators to bottom out, meaning the price is definitely oversold or in a position where it's undervalued. I'm looking for the market cycle where the asset is undervalued, and I'm looking at sentiment. Are people on Twitter or are my friends panicking, worrying? Are they capitulating? Are they selling everything that they have because they're sure the price is going to keep going down? If that's the case, then the probability that we're near the bottom is higher for me, and I will go ahead and make that buy and position myself for the rebound. And as that rebound takes place, I'm paying attention to market sentiment, I'm paying attention to market indicators and my oscillators, and I'm seeing if price is behaving how I want it to behave. If it keeps doing exactly what I want, I stay in the trade, and if it deviates from my planned path for it, I get out and I take my profit early. Risk management is a really important lesson, and it's only something you can learn after having traded personally yourself with your own money. Peter Brandt talks a lot about this, and it's basically taking a quick loss, being okay with losing a little bit of money because it's going to allow you to manage your risk and stay in the game and make money in the long term. You see, you can't be a trader and expect yourself to win on every single trade. As I said, it's all probability based. So even if you're making a good decision, there's still some probability that the trade is going to go against you. And when that happens, the best thing to do is take your losses quickly and then reevaluate. So as I said, I don't want to go into the specifics of my strategy in this video because it actually gets quite technical, and I really had to sit you guys in front of a computer and look at some graphs and charts to be able to show you exactly what I'm looking at. But what I will provide you with are some keywords and search terms that you can look at now that you can use to research these topics yourself and build some strategy around it before my next video comes out. So the first thing I look at are oscillators. These are things like RSI, Relative Strength Index, MFI, and these are basically momentum-based oscillators that will go from overvalued to undervalued. And for the biggest things that I'm using these for are figuring out where I am in the cycle, how much room there is for additional upside or additional downside, and I'm also looking for divergences. Divergences are basically disparities between price action and the behavior of these oscillators, and they typically mark the intermediate tops and bottoms of price action. The next really big thing that I look at is what's called Elliott Wave. Elliott Wave is a theory on how stock prices move, and I found a lot of corollaries between it and market cycles themselves. And I found that market cycles give you an understanding of how markets move and the general shape and market sentiment that you should be expecting. Elliott Waves gives the turn-by-turn directions on how that market cycle plays out. And along with these turn-by-turn directions that Elliott Wave gives me, it also gives me specific price points and behaviors that I need to watch out for that tell me when to get out of the market when things are moving not the way that I expect, and ways to confirm moves when price is going the way that I expect it to go. So I use things like pitchforks and channels along with Elliott Wave to basically make that determination. I use Elliott Wave in conjunction with Fibonacci numbers, basically Fibonacci extensions and retracements, to basically find where I'm gonna buy and enter a trade, and also where I'm gonna sell and take profits. So between oscillators, Elliott Wave, and looking at market sentiment, that really makes up the core of my trading strategies. I know that that sounds overly simplified right now, It's really because it's hard to go into this in this video and keep this video short still. But if there is interest in this, I will put out a video that looks at this more in depth in the future. So please let me know if you found this video insightful. Like it, leave some comments if you have questions, and please follow my channel if you'd like this type of content. See you in the next one. Thanks guys, bye.